What we're talking about today, it's really much more of a speculative, people are speculating on it. But most importantly, what I think about most of these cryptocurrencies, it just identifies how much money laundering there is being done in the world.
In 2017, Larry Fink called Bitcoin an index of money laundering. Fast forward to today, and his firm, BlackRock, has launched a multi-trillion-dollar digital fund on the blockchain. This isn't just a change of heart, it's a hostile takeover of the global financial system. Right now, while the world is distracted by the daily price swings of Bitcoin, the titans of the old financial world are quietly making a move that will change your bank account forever. BlackRock, JPMorgan, and Visa. These are the names that define global finance. They are the firms that control the flow of capital across every border, in every currency, on every continent. And they are no longer just experimenting with blockchain. They are building a new digital layer for the global economy, using stablecoins. It is the single greatest economic power shift of our generation. Today, on Finance Untold, we are going behind the curtain to reveal the institutional playbook. Why a stock you've probably never heard of just doubled in a month, and a Wall Street titan's shocking prediction of what will happen with stablecoins. But before we dive into the trillions, let's define this simply for anyone who is new to the space. Think of a stablecoin as a digital dollar that moves at the speed of the internet, but unlike Bitcoin, its value never changes. It is the bridge between the old world and the new. It's the stability of the US dollar combined with the raw power of the blockchain. To understand why the world's biggest banks are pivoting so hard, you have to realize that the current global financial system is essentially running on 1970s technology. We live in a world of instant messages and global video calls, yet when you send a wire transfer today, it doesn't actually move instantly. It passes through a dozen middlemen, it gets hung up in correspondent banking networks. It takes days to settle, and it costs a fortune in hidden fees. Every second that money sits in transit is a second that it isn't earning interest or being reinvested. The big institutions are aware of these constraints of the current money rails, and are moving full steam ahead with stablecoins. JPMorgan didn't wait for permission. They launched JPMCoin to solve this exact problem. Today, they use it to settle billions of dollars in trades every single day, 24/7. No bank hours, no weekend closures, no clearinghouses, and no delays. This is what we call programmable money. It is capital that moves at the speed of an email. When one giant institution buys an asset from another, the payment and the ownership change hands at the exact same microsecond. Then, you have Visa. Most people think of Visa as a plastic card in their wallet, but Visa is actually one of the largest payment rails in the world, and they are currently rebuilding those rails to be crypto-native. By integrating stablecoins, they are proving that the future of global commerce isn't in plastic, it's in digital ledgers. They are reclaiming the power that traditional banking lost to the internet decades ago, and rather than fight the technology, they are absorbing it. They are turning the blockchain into the new high-speed rail for the world's money. But the real untold story, the one that should have every investor on high alert, is BlackRock, the largest asset manager in the world, with over $14 trillion of assets under management. To understand the scale of what's happening, you have to look at the massive U-turn made by their CEO, Larry Fink. Only a few years ago, Fink was a vocal skeptic, but today he is the loudest voice in the room calling for the tokenization of every financial asset on Earth. But what does that actually mean for the economy? And more importantly, what does it mean for you? Think of it this way. Right now, if you want to invest in a $100 million office building in Manhattan or a massive plot of agricultural land, you need to be an institutional giant. Those assets are illiquid. They are slow to sell, they are expensive to manage, and they are gate-kept by the elite. Tokenization changes the math forever. By using stablecoins as the settlement layer, BlackRock can fractionalize that building into 1 million digital tokens. Each token represents a tiny piece of the deed, and they can be traded 24/7, globally, with the click of a button. It is the democratization of private equity. It means a retail investor in Tokyo can own a piece of a warehouse in Texas and receive their rent payments instantly in stablecoins, every single month. And BlackRock isn't just talking about this as a future concept. They are doing it right now. They recently launched BUIDL, their first tokenized fund on a public blockchain. It is a treasury fund where the shares are digital tokens and dividends are paid out instantly to your digital wallet. This is the infinite liquidity loop. No more waiting for T+2 settlement times, no more waiting for banks to open on Monday morning. Just instant, programmable, verifiable value. For BlackRock, this is about survival and scale. If they can move $10 trillion of assets onto a digital ledger, they reduce their administrative costs to nearly zero, while increasing the speed and efficiency of the entire global market. As an investor, your edge is recognizing that the world's largest asset manager has already chosen the winner. They aren't betting on the casino side of crypto, but rather they are betting on the plumbing of the future. Now let's look at the actual engine room of this system. You have to understand how these stablecoins actually maintain their value, because not all stablecoins are created equal. There are three main ways these coins stay stable. First, you have fiat collateralized coins. This is the gold standard for institutions. For every digital dollar issued, a company like Circle or Tether holds a real US dollar in a bank vault or in short-term government treasuries. It is quite literally a digital receipt for real-world cash. This is what JPMorgan and Visa prefer because it is regulated, audited, and transparent. Second, there are over-collateralized coins. These don't use dollars in a bank, they use other crypto assets as insurance to back the value. Usually they hold more than $1's worth of crypto for every digital dollar they issue, creating a safety buffer. And third, you have algorithmic coins. These use complex smart contracts to balance supply and demand to keep the price at $1. But these are much more complex and riskier. They rely on math rather than collateral. And when the math fails, the coin collapses. The two dominant stablecoins today are USDT and USDC. Combined, they have roughly $315 billion in circulation. Which brings us to the company that just doubled in a month. Circle Internet Group, ticker CRCL on the New York Stock Exchange, is the issuer of USDC, the world's most used stablecoin by transaction volume. They went public in mid-2025 at $31 a share. What happened next was textbook IPO euphoria. The stock rocketed to nearly $300 as investors piled in, then collapsed back down to around $50 by early 2026, when the hype wore off and reality set in. Most people wrote it off, another overhyped tech IPO that couldn't sustain its valuation. Then something interesting happened. In late February, Circle reported Q4 earnings that blew Wall Street's estimates out of the water. Earnings per share came in at 43 cents versus expectations of 35 cents. The stock jumped 35% in a single day, and it hasn't really stopped since. Circle stock has more than doubled from its February lows. Mainstream Wall Street institutions are now putting their credibility behind this company and stablecoins as a whole. Now, just recently, one of the greatest macro investors in history, Stanley Druckenmiller, who ran a hedge fund that averaged 30% annual returns for nearly 30 years and never had a single losing year, said this in an interview.
Blockchain and the use of stablecoins, if you want to throw crypto into that, tokens, incredibly useful in terms of productivity. I assume our whole payment systems will be stablecoins at 10 or 15 years. Efficient, quicker, cheaper.
And remember, Druckenmiller is specifically not talking about crypto speculation. He's talking about the plumbing, the part of the financial system that moves money from one place to another. He thinks that plumbing is getting replaced. And based on everything happening right now, the bank integrations, the regulatory framework, the AI payment trends, the transaction volumes, it's hard to argue he's wrong. In fact, his 10 to 15-year timeline might be conservative. Consider what U.S. Treasury Secretary Scott Bessent said recently, that the stablecoin market could grow from $315 billion today to $3 trillion by 2030. That's roughly 10 times in 4 years. The infrastructure is already being built. The legal framework already exists. The major payment networks are already using it. At some point, this stops being a prediction and starts being a description of what's already happening. It's also worth noting that there's one more layer to this story that most people overlook. Stablecoins have to move over some type of rails, and they are called blockchains. Two networks are positioned better than almost anyone else to benefit from what's coming. Ethereum, the institutional backbone, where JPMorgan and BlackRock are building, and Solana, the speed layer, where transactions settle in under a second for fractions of a cent. Which one ultimately wins the stablecoin rails war, and what that means for investors, is a deep enough story that it deserves its own video. Stay tuned. For now, understand that the stablecoin boom isn't just good for stablecoin issuers, it's rocket fuel for the networks underneath them. We'll be covering the stablecoin story as it develops, including the new exciting trend of AI agents utilizing stablecoins autonomously, and many other topics. Like and subscribe to support the channel if you found this entertaining or educational. See you next week.